Here is a number that should stop you. Charlie Munger, Warren Buffett's partner at Berkshire Hathaway for over 50 years, was worth approximately $2 million at age 50. By the time he died at 99, that figure was $2.6 billion. Most of his wealth was built not through stock tips, not through financial analysis, and not through connections on Wall Street. It was built through a system of thinking that Munger spent decades studying, and almost nobody in the mainstream financial press has ever described accurately. He called it a latticework of mental models. And it is the actual engine behind the most successful investing partnership in history. Act 1, the misunderstanding, what people think Munger did versus what he actually did. Most coverage of Berkshire Hathaway focuses on Warren Buffett, which is fair. Buffett is the public face, the annual letter writer, the Omaha sage. But people who have studied the actual decision-making at Berkshire closely, including people who attended the annual meetings for decades, consistently point to a dynamic that gets almost no airtime. Munger was the one who changed how Buffett thought. In Buffett's own words, Charlie shoved me in the direction of not just buying fair companies at wonderful prices, but wonderful companies at fair prices. That single shift in framework from the narrow value investing Buffett learned from Benjamin Graham to the broader, quality-focused approach Munger advocated accounts for the majority of Berkshire's outperformance over the past 40 years. What Munger actually read? Munger was not primarily a finance person. He was a reader of psychology, Cialdini, William James, evolutionary biology, physics, mathematics, and history. His argument was that the biggest investing mistakes are not analytical failures. They are psychological ones. And to correct for psychology, you need to understand it from first principles. The financial media version of Munger is patient, contrarian, long-term focused. All true. But those are descriptions of behavior. The more important question is what produced that behavior, and the answer is a framework for thinking that most investors spend zero time building. The insight is not be patient. The insight is why patience is structurally undervalued, and how to build the cognitive machinery to access it reliably. Act 2, the 4 mental models, the actual latticework 4 models that changed Berkshire. Model 1. Inversion. Munger did not ask, how do I build a great investment? He asked, what would guarantee a terrible one, and how do I avoid doing that? This is called inversion, and it comes from mathematics. The German mathematician Carl Jacobi made it a core habit. Invert. Always invert. Instead of working toward success, identify the conditions of failure with precision and engineer your system to eliminate them. Applied to investing, Munger's inversion produced a checklist of what not to do that was more valuable than any buy list. Don't invest in businesses you don't understand. Don't leverage to a point where a bad year becomes an unrecoverable year. Don't invest with people you don't trust, regardless of the numbers. The negative logic builds a much more durable filter than the positive one. Inversion in practice. Munger's checklist approach, literally writing down all the ways a business could fail, was more rigorous than most institutional due diligence. He called it avoiding stupidity rather than pursuing brilliance. The data on this, studies of professional fund manager errors, consistently show that the worst outcomes come from the same 5 or 6 failure modes. Mapping those modes in advance eliminates most of them. Model 2. The Lollapalooza effect. This is a term Munger coined, and it describes one of the most underappreciated dynamics in investing. A Lollapalooza is what happens when multiple independent forces all push in the same direction simultaneously. Not one good reason to buy a business. 4 or 5 structural advantages all compounding on each other at the same time. His example, Coca-Cola in 1988, when Berkshire bought its first major position. The brand had global recognition. The product had a near addictive quality through sugar and caffeine. The distribution infrastructure was irreplaceable. The business generated cash without requiring capital reinvestment at the same rate. Any one of those factors would make it a decent business. All 4 together compounding made it a Lollapalooza. 1,100% Berkshire's return on Coca-Cola, held since 1988. Model 3. Psychological biases as investable facts. Munger spent years cataloging what he called the psychology of human misjudgment. He gave a famous Harvard speech on the topic in 1995 that is still required reading in certain finance programs. He identified 25 distinct cognitive biases that reliably cause intelligent people to make terrible financial decisions. The investing implication. These biases are systematic and predictable. If you understand that social proof causes people to buy what others are already buying, which inflates prices beyond fundamentals, you can look in the opposite direction. If you understand that loss aversion causes people to hold losing positions too long, you can build rules that override that instinct before it activates. Munger's edge was not better information. It was a more accurate model of how other market participants would behave and positioning to benefit from their predictable errors. Model 4. The opportunity cost frame. The most practically transferable thing Munger ever said about investment decision-making is this: every investment you make is automatically a rejection of every other investment you could have made with the same capital. The question is never, is this a good investment? The question is this the best use of this capital, given everything else available? This reframe eliminates an entire category of mediocre decisions. A business returning 8% per year is a good business in isolation. It is a bad decision if you are giving up a business returning 15% with similar risk to own it. Munger's framework treats holding cash as having an implicit benchmark and forces every potential investment to clear that benchmark explicitly before capital is committed. Act 3. What regular investors can use. The 3 extractions. What actually translates here is where the Munger framework gets interesting for someone who is not running a $300 billion conglomerate. Most of what Munger taught is not about which stocks to buy. It is about building a decision-making architecture that prevents the errors that cause most investors to underperform. That architecture is entirely replicable. Extraction 1. Build a personal checklist before any significant investment decision. Write down explicitly, in advance, the conditions under which you would not invest. Not I'll think about the risks. A written list of specific failure modes. Inversion, applied. Munger's version was developed over decades. Yours starts with 5 items. What business quality threshold am I not willing to go below? What price-to-value ratio makes this not worth the risk? Do I understand how this business makes money well enough to explain it in one sentence? If any of those answers are no, the checklist stops you before your enthusiasm does. Extraction 2. Wait for the Lollapalooza. This is the practical equivalent of the high-conviction patience that defines Berkshire's approach. You are not looking for one good reason to invest. You are waiting for a situation where multiple independent quality factors converge. In practice, stop making decisions on single variable logic. This stock looks cheap, or this company has great management. Instead, require 3 or more independent reasons before committing capital. The frequency of your decisions drops dramatically. The quality of each decision rises in proportion. The patience math. Munger made roughly 50 major investment decisions across a 50-year investing career. 1 per year. The average investor makes 50 in a given month, most of them driven by noise, momentum, or social proof. The research on trading frequency is clear. The fewer decisions made, the better the outcomes. Waiting for the Lollapalooza is not passivity. It is the most active form of discipline available. Extraction 3. Map your own biases. You do not need to memorize Munger's full list of 25 cognitive biases. You need to identify the 2 or 3 that most reliably affect your specific decision-making. For most retail investors, the dominant bias is recency, weighting recent events far more heavily than they deserve. The stock that just went up looks like it will keep going up. The crash feels like a permanent new reality. If you can identify when you are operating under recency bias specifically, by comparing your current sentiment to what you felt 3 years ago about the same asset, you can, at minimum, pause before acting. That pause is worth more than most investment research. Act 4. Does it work today? The 2026 objection, and why it misses the point here, is the objection worth taking seriously. Markets in 2026 are structurally different from the markets Munger operated in for most of his career. Passive investing now represents roughly half of all equity market capital. AI stocks have driven index concentration to levels not seen since the dot-com era. The best growth companies are staying private longer, meaning public market investors often access them after the most valuable phase of growth has already happened. These are real changes. They affect the availability of the kind of undervalued, high-quality businesses Munger built his record on. But here is what hasn't changed. The psychological biases that cause investors to buy high and sell low are the same today as they were in 1975. The math of compounding is identical. The value of a durable competitive advantage, pricing power, switching costs, network effects has not diminished because markets are more efficient. If anything, in a world where passive capital flows automatically and systematically into the largest companies, the opportunity to find quality that is genuinely mispriced has become more specialized, not less real. What Munger would say about now, in his final interviews, Munger was consistently clear that the era of easy value investing, buying cigar-butt businesses at deep discounts, was effectively over. What remained was finding businesses with genuine durability and holding them long enough for compounding to do its work. That observation is more relevant, not less, in a market dominated by passive flows and short-duration thinking. The mental models translate, the patience translates, the checklist translates. What requires adaptation is the specific universe of businesses you apply them to, and the recognition that in a more efficient market, The required holding period to capture the full value of a quality business has lengthened, not shortened. Charlie Munger spent 49 years building a latticework not of stocks, but of ideas. Frameworks borrowed from disciplines most investors never open. Checklists assembled from failures he cataloged obsessively. A bias map drawn from psychology books, not Bloomberg terminals. None of it required a trading desk. None of it required access. All of it required something most people find harder to come by than capital. The question worth sitting with tonight is not whether you can replicate Berkshire Hathaway. You cannot, and neither could anyone else. The question is whether the reason your investment decisions have not compounded the way you hoped is an information problem or a thinking problem. Munger spent his life arguing it is almost always the latter. And the evidence, on balance, suggests he was right.